In our last section, we explored excess and umbrella liability contracts, which can be a critical addition to your client's portfolio of coverage. These contracts are available for both personal and commercial lines, but there are some differences between the two. For simplicity, excess liability policies extend coverage provided on the underlying policies in just about every instance, and there are a few that grant additional coverage that even goes beyond what the underlying contracts cover. Umbrella policies provide protection on a slightly different basis. Depending on the policy, umbrella contracts can provide coverage even if the underlying contracts do not. Pay attention to the exclusions for these policies, as there are a few that are somewhat unusual. Next, we're going to explore specialty liability policies. These policies are intended for specific professions and trades and cover professional liability exposure, whereas commercial general liability policies won't. For example, if a producer sets up incorrect coverage for a client and the client suffers a loss due to the producer's negligence, that is not covered. We'll discuss a number of contracts that cover professionals from liability due to their negligence. While there are dozens of different professional liability policies available, we're only going to explore those that are seen fairly often by insurance producers. In this study, we'll also look at the numerous exclusions attached to a professional liability policy. A caution here: failure to correctly identify applicable exclusions to an insured could be grounds for a professional liability suit. While it's not always the case, many exclusions found in these policies can be eliminated by adding proper endorsements to the contract. For example, pollution is typically an excluded loss on most commercial policies, so if the insured has a pollution exposure that needs insurance protection, there are endorsements and policies that can cover them. The final part of this section deals with sureties. This is the industry term for bonding, and the purpose of a bond is to provide a financial guarantee to have certain services performed to a minimum level. Many professions and trades require bonding as a condition of licensure. For example, construction contractors have to provide their state that they're both bonded and insured in order to get a business license issued. Bonds are used every day in the insurance world, but they're not insurance products. Rather, bonding is an extension of credit to the person who must provide the bond, and you'll see that creditworthiness plays an important role in surety contracts. Pay attention to the three parties involved in a surety contract: the principal, the obligee, and the surety. The lesson goes into detail on the identification of these parties and their roles in the surety process.